Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by Oppenheimer Funds. There are big investment opportunities beyond our borders. Megatrends is a podcast from Oppenheimer Funds that explores the trends reshaping the global economy. Subscribe to Megatrends wherever you listen. This week on the podcast, we're pleased to present The Restaurant Industry is Evolving, a special presentation by Morningstar equity strategist RJ Hadavi from the management behind the Moat conference.
About a year ago, we noticed that the conversation we were having with a lot of the restaurant management teams we talked to, both public and private, were very similar to the conversations we had with retailers about 10 years ago or so. They're facing delivery. They have to do with mobile order and mobile payments. And so the same kind of conversations that we had, and frankly, there was a lot of confusion about how they go about it. Do we need to have a delivery program? Do we need to do these kind of things? It reminded us a lot of what we were hearing. And since we've done a lot of work with the retailers over the past decade or so, we thought we'd try to apply some of that to the restaurant space and really develop a new playbook for you as investors, either public or private, to analyze restaurant companies with. And I think this is actually probably broader than that, too. I think some of the lessons we'll talk about today can be applied elsewhere in the consumer space. So as a starting point today, I want to highlight two ideas. Both have popped as of late in the third quarter earnings, but we still think they're valid. Kind of a 1 to 3 year horizon idea, and that's McDonald's. I think the idea here is this one is doing a lot of things right. It dovetails a lot of themes we'll talk about throughout the day in terms of technology and adding convenience and adding the utmost flexibility for consumers, because that's what they're looking for at a concept like McDonald's. On top of it, it's a pretty healthy capital allocation plan, almost a 3% yield right now, so you effectively get paid to wait. I think they're going to have a big 2019 with the Experience of the Future initiative that they have, the kiosk ordering. I think that's going to benefit traffic midway through the next year. And then even over a longer term horizon, I know they had a big quarter last week, but Starbucks still is a name that's pretty interesting to us. I think that they still have some issues to work out in the U.S., but things that can be solved. I think there's a tremendous China opportunity, and they will be one of the more interesting CPG players in the coffee space as well. So I'm going to divide the presentation into two parts. The first is we're going to do 10 predictions for the restaurant industry over the next, let's call it 2 to 3 years. And then the second part, I'll transition into some of the questions you should be asking management teams in the restaurant industry and some of the key metrics that help you evaluate whether or not they're adapting to what is a quickly evolving consumer environment. So the first prediction for the restaurant industry, and I don't know if anybody sat in on the General Mills presentation this morning, but this kind of dovetails with it. So far, if you look back the last 2 years in the grocery industry, the big news was Amazon Whole Foods. Yet we really haven't seen much of an impact from that integration at this point. However, I think we're starting to see just the early signs that grocery stores are getting more worried about that potential impact. I think with Amazon bringing the Prime membership in the real world, I think that was kind of the key lever here that now all of a sudden, we might start to see some real impact from Amazon Whole Foods. And so we need to keep prices low. And this is a chart that shows food away from home CPI and food at home CPI. Right now it's been pretty, restaurants have been running about the 2-3% inflation range, the blue bar on the top. And then if you look at food at home, which is the grocery store inflation, that got pretty artificially low in 2017, but it's since kind of rallied back. But we see that little tail at the end here. It's starting to widen out again. So I think if you look in the back half of the year, you're going to see a lot of grocery store chains keep the prices low to keep the traffic they may have as a way to combat Amazon Whole Foods. The flip side of that, that's going to put a lot of pressure on restaurant chains, which are already suffering from tough traffic. They're not going to have much pricing opportunity. They're going to have to keep their prices low. So I think even though we saw a pretty good third quarter out of most restaurant chains, I think you're going to see a lot of pressure in terms of pricing, and that's going to keep comps in that 1 to 2 range for most chains, even some with negative numbers on that. Because of that pricing pressure, I think what we're looking over the next 5 years is actually a contraction in the number of restaurant units that are out there. In fact, we're projecting a low single-digit decline in the number of units. We still have the fast casual category growing about 6.4% over the next 5 years, but that's down from about 10% from the 5 years prior to that. And then if you look at the traditional, fast food and casual dining space, we have those declining. I think it's going to be very difficult for those small chains, particularly the ones between 0 and 10, that have spread themselves too thin. Maybe if you're in one market and got scale there, you'll be fine. But if you're really spreading yourself too thin, it's going to be, I think, it could be a very difficult couple of years, particularly because competition with the grocery store channel and online grocery is not going away. So this is, and kind of dovetails to this next slide, which shows we actually think that restaurant industry growth is going to decline from 4% to about 3%. That's a pretty big move too. And if you look at some of the categories within that, there's a substantial decrease in the growth rates there. One of the interesting things to point out here is other, which is kind of the non-traditional channel, some of the hybrid things, vending, some of the other things that are starting to develop in the restaurant space. That actually is going to accelerate, and that's also going to put downward pressure on industry sales across other categories. However, I don't think this should spook investors in restaurants. I think what you're seeing is that those chains that have made adaptations to their business model for what we're seeing in the consumer space are positioned well. They should continue to grow, but that's a small group right now. And to be honest, the conversations I'm having in the restaurant space is people are really still trying to figure it out, but there still is opportunity for those companies that are adapting to consumer preferences. In terms of valuation, what's been interesting, if you look back the last 10 years in the industry, there was really it's been almost essentially a 3-act play. From 2009 and 10 to about 2014, you saw average PE multiples in the space go from effectively the high teens to the low 20s. A lot of that had to do with rotation out of retailers and into restaurant names that didn't have an Amazon-like disruption imminent. And so you saw that then multiple re-rate to about the low 20s. From there, from 2014 to about beginning of 2017, you saw another re-rate where you saw the PE multiple go to the mid-20s, and that had to do with the fact that most of these companies are selling off their company-owned locations to franchisees, then taking on additional debt, and then returning the proceeds from that to shareholders in the form of dividends and buybacks. That has effectively played out now. There's not as many locations to franchisee or to sell to franchisees. Most of the companies are running north of 95% in terms of the franchisee ownership. So that trade has effectively parsed its way out. Now we're back down to kind of low 20s PE multiple for the space. That's probably the right range. Most of the discounted cash flow modeling that we do suggests that's probably the right multiple to be paying for these names. However, with what we talked about in terms of downward pressure on traffic, downward pressure on pricing, you may get a better opportunity on these names going forward. The bullet point here in terms of prediction, it's talking about Starbucks, and I think this is a great case study to kind of encapsulate what's going on with the market here. Starbucks it has been, up until this past quarter, and even this past quarter was mostly driven by price increases or mix shifts. Traffic there has been flat to declining over the past 3 or 4 quarters, and I think it underscores one of the major changes that we're seeing across the industry. We think that their recovery still is going to be somewhat volatile. We do think it's a great long-term opportunity, but they still have some things to figure out. And I think what the main message here is that if you think about Starbucks, they built their brand on being an experience. It was the third place away from home in the office, utmost customer service. And when you introduced mobile order and pay a couple of years ago, then you're trying to serve 2 audiences at once. You have this convenience customer that wants their coffee very quickly, in and out. And when you try to do both of those at the same time, frankly, you don't do it very well. The idea of convenient experience is an oxymoron. It just doesn't work that way. And so I think that they're still figuring out how to adjust that. And I think that can be applied to the rest of the restaurant industry too. I mean, that was the one thing when we went out and shared our results from our piece with a lot of restaurant operators, that seemed to be the thing that resonated most with them, is the idea that, okay, we need to focus on one thing or the other. Certainly there's elements of, with an experience aspect, you can make it convenient. If you have convenience, you can make it, an upscale experience. But you need to really focus on one of these 2 aspects, one of these consumer need states, and then dictate that should dictate your hiring practices, your technology implementation, your supply chain, a lot of the other things. And I think, getting more directly at Starbucks, the way to think about it is, they've got these great locations, large, experience. I think those are the kind of locations you need to start parsing out a little bit on the delivery and the mobile order side. Carve that out, maybe a small percentage of square footage for that. But I think the real opportunity for them is to create smaller format express stores that really, all they do is pump out throughput here and get more and more transactions through. I think that's going to be the big opportunity. And I think the management team does realize that, but it's still going to take a couple of years to play out. That's why it's more on the 3 to 5 year trajectory. But I think that's one of the key messages as you start to think about investments. And this, again, would apply both to not just restaurants, but also retailers. What is the need state they're serving, and have they put together a game plan to satisfy that? So the next projection for the restaurant industry is that looking at next year, those companies that have invested in the technology, the appropriate technology for either a convenience or an experience state, those are the ones that are going to start to see improvements in next year. I think McDonald's is the key example here too. And this is just kind of shows you where we've been in terms of not only comps for the space, which has been in the low single-digit range for the last 2 years, but then also traffic, which has been, frankly, actually, in the negative 1 to 2% range for most restaurant chains. I think we're going to start to see a bit of improvement for those players that have invested in the technology. And by the technology, I mean the ones that have set up mobile order and pay, but not to the point where it impedes anything else going on in the restaurant. It can be timely, it can be accurate, it can be reliable. Those companies that have done that, those that have actually put together a reasonable delivery platform. And again, we'll get into delivery more because that's a big trend going on in the industry. But the ones that have done the right approach to delivery, you're going to start to see some benefits. So I do think that there are opportunities for those players who have been early technology adopters and the ones that invested in the right technology. This is the next prediction. I mean, delivery's not going away. No surprise there. I mean, this is an environment where Amazon has retrained consumers to respond to convenience. Right now, delivery is about 6%, or about right around 6% of total sales, about 3% of overall transactions. So, and it's not going to go away over the next 5 years. That's effectively going to, we'll see 3 points of improvement in terms of percentage of overall sales. That gets you about 4% of overall transactions too. It's about 2 times the average ticket when you do delivery because it's group orders and family orders and things like that. But delivery's not going away, and so you as a restaurant chain need to have a suitable plan. And again, not every chain's going to need to do delivery. This can also be to-go orders too, and I think we're seeing that more on the casual dining side. But think about the way to best structure it to adhere to the need state that you're serving. This is where our team at PitchBook was hugely helpful in this report. One of the things we're seeing, and I talked about the valuations coming down in the restaurant industry over the last couple of years, again peaking about early 2017. What we've seen in the heels of that is actually a big technology boom, and it makes sense because all these restaurants are trying to figure out the best way to adapt to all these consumer changes. So basically every function within a restaurant now has some sort of technology aspect to it, from the ordering platforms to the delivery aggregators that are out there, to staffing management, to inventory management. We're seeing a big technology boom in this space, and valuations, to be honest, are a bit crazy. A lot of investment in this. Some will survive. I think there'll be a lot of shakeout and consolidation in the space too, but I think it's going to continue over the next couple of years as restaurants are desperate to not only generate traffic, but also keep costs in check. And again, just some other examples of companies that are there. It's in the full report if you can't see the graphics here. And then kind of some other things from our PitchBook team in terms of just industry expectations. We've talked about valuations coming down, so I think that what we're starting to see is some opportunities open up and a lot of M&A activity. One of the executives I spoke to for this report told me, does it make sense for anybody to be public in this market right now? These small to medium-sized mid-cap companies, basically anything under $10 billion in market cap that's not a big franchisor. With all these changes that need to take place, that's going to require a lot of capital, and it's not something that happens overnight. Most of the time, most of these technology platforms, usually it's about a 3 to 4 year rollout platform, and so a company like McDonald's is probably in year 2. What happens is that's going to require a lot of time, a lot of patience, and frankly, we're not going to. A lot of people in the public market are not going to give these restaurant chains that kind of time frame to work with. So we're probably going to see some other big deals happen. I don't think I'd anchor my investment strategy around that, but we will probably see a lot of operators taken out in the space. Even since this report's been published, we saw Sonic and Bojangles taken out, at pretty decent multiples too. I don't think we're done yet either. I think we're going to continue to see some M&A activity over the next couple, really into 2019. At that point, we'll see what happens, but it's going to depend on capital markets. And then the last projection is, we just talked about the idea of, does it make sense for a lot of restaurant chains to be public? To be honest, we don't actually expect any IPOs in the space over the next 2 years. I mean, if you're looking at the next potential candidates, I think there's 3 of them, Sweetgreen, Blaze Pizza, and Mod Pizza. But honestly, the management teams, we spoke to them all, they're not ready yet, and they see what's going on in the capital markets, and it really has not been a great time for any of the restaurant IPO class of 2015 and 14. Most of those are struggling right now. now. And so I wouldn't expect to see any IPOs in this space over the near term. But what we do expect is actually some of those restaurant technology firms. That's where you're probably going to see some IPOs. Might be a way to kind of play this whole idea of changing technologies, and there might be even more opportunities this time around than what we saw at the retail space about a decade ago. Some names like Toast, which is a POS system, Hot Schedules, which is a labor and inventory management system, Olo, which does some of the the linking between the delivery platforms and the point of sale system. Those are the names that are already kind of on their Series D and Series E type financings that might be the next IPO candidates in the space.
This podcast is brought to you by Oppenheimer Funds. There are big investment opportunities beyond our borders. Megatrends is a podcast from Oppenheimer Funds that explores the trends reshaping the global economy. Subscribe to Megatrends wherever you listen.
So now I want to shift gears and talk about just the most important questions you should be asking yourself as a restaurant investor or retail investor, or the management teams that you work with or talk to in the restaurant space. And this is kind of a quick overview, but we'll run through the key metrics that you should be measuring those answers with over the next couple of slides here. So as a starting point, what we looked at, and I think this is probably the right way to think about it, just in terms of anchoring all your investment decisions, is take a look at the average transaction size. That's a good starting point. So this is a chart that shows the average ticket for it's actually the last 5 years for each of the a sample group of about 20 restaurant chains we looked at. What's interesting about this is it can kind of show you opportunity, or places where pricing might be out of line. Maybe a company's charging too much to try to offset some costs there. Maybe they're undercharging to drive traffic. If you see kind of weird imbalances on that, that's a good starting point to really start probing management on what their long-term strategies are. But what's more important from this, because when we now know the average transaction size, we can back into the number of transactions the company has. And more importantly, what we decided that the average transaction per square foot is probably your most important metric going forward. That picks up on things like delivery, that picks up on things like changes to the store format. Those are the kind of things to be looking at. So I think that this metric, and particularly growth in this metric, is going to be your key metric going forward that you really have to focus on. Those companies that outperform on that generally are doing something right, either demand creation or adjusting to the marketplace in terms of new technologies, new formats. So we like to think that this is going to be an important metric to monitor going forward. Now, that leads us to our next question is, how do you deal with consumer fatigue? One of the things about the restaurant industry is we see a lot of, short attention spans. People like new things right away. They see something on a food channel. They want to try it out in the restaurants. It can be very much a shorter attention span. We see the limited time offers, the new products that are out there, changes very rapidly. So how do you deal with that? And one of the ways is, now that we know how many transactions this company has, now we can start to back into a transaction acquisition cost number here. So we take the marketing, the incremental transactions divided by the marketing costs, and we kind of come up with who's doing it right, who's able to drive traffic organically or with minimal investment. One of the things we do see is obviously there's the up and coming brands like a Shake Shack, for example, does very little marketing, and that makes sense because the word of mouth and buzz carries it. But at a certain point, and I think Chipotle is a perfect example of this, at a certain point you either have to on a national level start to do advertising, or you start to have you maybe had a specific food safety incident that you have to start advertising. That doesn't last forever, but this is a good benchmark to show you who's driving traffic organically here. Again, some of the stands, I think McDonald's has been a very one. They spend a ton of money, but they do drive enough transactions through it. But it's an interesting way to kind of look at the space. The third topic I want to talk about is something that it comes up a lot, and probably in your day-to-day conversations. I know I had a couple conversations during the reception last night about it, but the idea of health and wellness, this is something, a buzzword across the entire consumer space right now. But what's interesting about it, too, is that we've had a thesis, and if anybody's looked at my previous research, we've had this idea that authenticity is actually the key driver. It's not health and wellness, but we wanted to try to find some ways to do this, and we did this in two ways. The first one was a study, to be honest, going into it, I didn't expect to find any kind of data from it. This is one of those things that we decided to try, see what would happen. What we did is we lined up all the brands in our sample group against 8 different keywords in Google Trends and kind of did a correlation analysis here. And this is something that there's too much spurious correlation. We're not going to find any key takeaways here. What we did actually find, though, is that those brands that had the highest correlation to the word authentic were also the ones that had the highest transaction per square foot growth the last 5 years. That was interesting. So a company like Wendy's, a company like Domino's, Starbucks, Dunkin', or Panera, those are all very interesting to us. But we wanted to take it a little bit further. And what we decided to do on this one, the next slide here, we took a look at calories per item and if there's any correlation with transaction growth here. What we found is there actually isn't a lot of correlation. It's almost a zero correlation if you look across the board. Now, obviously, there's some other factors there. If your brand is centered on being healthy versus not, marketed as such, there's things to keep in mind there. So, that's interesting to us, and that kind of proves the point that I think the idea that having authentic products, and by authentic, what I mean is that it's as close to being from the source itself, less ingredients, less preservatives, less additives. The General Mills, the CFO discussed that this morning too, and some of their products, cutting it out and making it more natural, authentic. It's also kind of a derivative on the idea of millennials and experiences. When they travel the world and come back and a lot of times they're going to want to recreate those experiences, and so restaurants sometimes become that outlet. And so if you can come up with the product that recreates a product from some part of the world that's popular in terms of travel, we've seen a lot of success stories on that front as well. We'll wrap through this the next couple topics here, the questions fairly quickly. But one of the other things too, we talked about technology and the importance of this too. Mobile order ahead. This is something we hear. You probably have all done it. In the last couple weeks. It's becoming kind of the way to interact with restaurant companies. The companies that are ahead of the schedule on this one, so Starbucks, Dunkin', I put KFC China because they're actually way ahead of the U.S. in terms of mobile order adoption and that. But effectively, when your restaurants are rolling out mobile order platforms, you should effectively see about 1 percentage point each quarter in terms of the percentage of overall transactions. That's when you're starting to really kind of resonate. You've got a technology platform that works, that's seamless for consumers to work with. And then one of the key topics that we've talked about in our previous research is, the ability to connect with consumers outside the four walls of the restaurant. Some of that's new products, some of it's advertising, but you really have to find a way to get people coming back. I mean, this is a no switching cost environment. It's very tough. I mean, consumers can pick whatever restaurant they want, so you have to find some way to build stickiness into it. And so this is where technology and kind of mobile platforms give companies an advantage. One of the things we'd like to look at too here is a loyalty program. You probably are members of it. Starbucks right now is about 14 million members in the U.S. You've got Panera, it's upwards of 25 million members at this point. What's interesting about it too, this can create some real stickiness and create, I wouldn't call it a moat source here, but it does create some advantages in the company here too. Those companies that can drive 2 times the traffic out of their loyalty programs, and we show that Panera is actually doing about 4 times the average transaction for their loyalty program member. That shows you've got some real stickiness with your brand there. It can be another supportive to a brand intangible asset. Delivery, we talked about this, and this, to be honest, is one of the most controversial parts of the restaurant industry today. Most restaurants see it as an opportunity to expand, and enter new category or enter new avenues of growth. But at the same time, there's risk inherent with it. That restaurant item leaves the restaurant. You never know how it's going to end up when you get to the consumer's home. And again, it's the brand that suffers, not the delivery company on that end. But I do think that most chains have to have at least some exposure to delivery. I think what we're seeing is most of the large QSR players partner with one of the large delivery aggregators, so McDonald's and Uber Eats. You've got Yum Brands and Grubhub. You're finding that they find one partner to kind of learn the game. I would not be surprised to see those companies over time build that in-house because the economics work better when you do have your own delivery services. You don't have to pay that commission. Obviously the pizza companies right now way ahead of the QSR firms, which are generally in the 2 to 3% of sales in terms of delivery, and about 1 to 2% of the overall transactions. Pizza guys have been doing it for a while and show that it can work, and having your own internal fleet of delivery drivers does make sense. This is the fast casual guys here too, about the same as where we were at the QSR. I think over time we're going to see this, again, over the next 3 to 4 years or 5 years or so, really effectively double for most of these companies. So you have to have a game plan in place. And some of the things we talked about in terms of, the technology, making sure you've got the right ordering system in place. It's got to be seamless is very important. The best strategy, does it make sense to go through a delivery aggregator, or do we have enough scale and route density to do something on our own? Those are the considerations that you should be asking restaurant management teams at this point. One of the other key topics in the space, and probably if I had to rank the #1 pressures for restaurant companies today, I think the #1 thing is actually labor. That's without a doubt the thing that came up most. And you see the push to $15 an hour minimum wage coming up over the next 5 to 10 years. So who can generate the most sales per labor hour? Can you creatively find a way to cut back on labor, or change the format of your restaurant to cut down on that? This shows labor or sales per labor hour over for every category in the restaurant industry. Generally, the average is about $40 in terms of sales per labor hour. So if you're not above that, you have to find ways to do that. And so this is what we're seeing why companies like McDonald's are moving to more automated and technology-focused approaches, because you can cut back a bit on labor there. Every management team says, oh yeah, we're going to reallocate labor to something else. We're not cutting back on hours. But the reality is that they're moving to less employees, less labor hours to generate higher sales per labor hour. So this is another key metric to look at from across the different categories. And then I want to wrap up with a couple more practical things in terms of restaurant operations. Market expansion is a big topic for this one, and really the only way to survive in this industry is to build scale, like most industries. These are kind of some benchmarks that show where you should be at as both from average unit volume and margin numbers as your business expands. If your company's not doing these kind of numbers, then you have to start asking, is this the right approach? Should we be expanding, or do we need to refine our actual platform? Restaurant margins, which affected gross margins, if you're starting out, it should be in the low double digits. If you're a national company, something in the 20% range is good. Operating margins, this is a low margin business to begin with all the things we talked about with labor, and then we'll talk about rent in a minute here. Operating and labor cost, or just the input cost that goes with it. It's a pretty low margin business, but these are kind of the benchmarks that you should be looking at in terms of where that company is on a scale. Most of the companies we cover are going to be at the national level, so that's kind of the general benchmarks we use, or maybe in that multi-market stage. But if you're looking at kind of the upstart or the up-and-coming chains, those are kind of numbers that maybe 1 or 2 markets that you should be looking at. Apologize for the size of this, but this is build-out costs per restaurant here. Kind of the numbers that you should be using there. We're seeing a lot of creativity in the space. There's some. We talk about technology and the ways they've been able to restaurant operators have been able to use technology to drive down costs. We're also seeing some innovation on the restaurant formats. Restaurant chains finding ways to drive down that build-out cost. Some of these things. The Cubby format where you go in and you've already placed a mobile order. They have a kiosk. Then your food is ready in a couple more minutes. You can cut your labor in half by doing that. You can cut out your build-out costs by quite a bit by doing that as well. So these are some benchmarks in terms of build-out costs, and how to compare a restaurant concept to other players in the space. And then rent, behind labor, rent I would say is the other pressure we're seeing, especially we talked about unit growth the last 5 years. That was a big time for growth in the restaurant industry in terms of number of units. But what we're seeing is that the 5-year escalators on a lot of lease terms are coming up right now. So we're going to see rent costs continue to go up. These are just some general benchmarks in terms of rent per square foot. If you're looking at as a percentage of sales, I think 8 to 10%. Anything below that, typically right around the 8% of sales is probably the right number for a restaurant concept. Anything way above that, they're probably paying too much. If they're paying way below that too, that's also cautionary because maybe they're not in the right location to really drive traffic. And this is the last question that I think you should be asking, a restaurant concept is whether or not its supply chain is really scaled the way it should be. These are just some benchmarks in terms of, supply chain headcount, the number of distribution centers, the number of products they have. This is important because for those who follow the Chipotle story closely, this is effectively that company outgrew its supply chain. You had a situation where they had to outsource a lot of their supplies to smaller independent contractors, and you lose control of your supply chain, and you might get some bad produce or bad protein that goes through that. So this is kind of the numbers that you should be looking at in terms of along the way, each one of the what the supply chain should look like for a small, medium, and large size chain. This is just a quick summary, kind of the benchmarks for across all the topics we talked about. It's in the report if you want to look at it in closer detail. But I just want to wrap up with, we covered a lot of topics, a lot of points here. I want to make sure we kind of, is there a way to wrap this all up into quick, easy to digest data points? And I think there's really two here. One is restaurant level profits per square foot. So effectively gross margin per square foot. What are the companies that are doing exceptionally well here? Which are the ones that are not? I think this is an interesting benchmark to look at. And you see some real success stories stand out here. A company like a Domino's or a Shake Shack, Taco Bell. I mean, I think those are the companies that have done probably the best job over the last 5 years. Probably put Starbucks in there as well. But this could be an opportunity to kind of show which companies are maybe adapting to consumer expectations better than the market's giving credit for. And then one of the other metrics we came up with in this piece to kind of evaluate, what the market's saying about this company versus, maybe what they're really doing is take a look at EV to EBITDA divided by expected transactions per square foot growth over the next 1 to 5 years. We're looking at a 1-year basis here because maybe the market's underestimating the impact of the company's ability to generate transaction growth. This is where the picks that we provided earlier, McDonald's and Starbucks. Again, we ran this before third quarter earnings, but this is the numbers that kind of show maybe the market, in terms of EV to EBITDA valuation, is not giving them the full credit for the transaction growth that these companies might have. So another creative way to look at it, especially when transaction growth is going to be the key metric to look at in the restaurant space.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.